Welcome back to the 75th episode of Nvidia Saves does not save the markets today. This move in Nvidia definitely took Wall Street by surprise today. Nvidia is kind of crashing today, which I think makes the rest of this week and next week that much more interesting. But first, Tom Lee is right again. Literally spot on. Carl over on CNBC shared this image of Tom Lee and says SPX 5,500. A lot of people thought it was a crazy call to think the S&P would rally 4% in June. Tom Lee made that call and was correct. But indeed, we need to talk about what is coming next for markets. Tomorrow's option expiration is the largest in history at over $5 trillion. So do expect volatility coming tomorrow, but more volatility next week. Because indeed, when you get these option expirations that are massive, that only happen a couple times a year, you actually don't get a lot of volatility the week of expiration. It's actually the following week that you see a larger move in markets. That's because that $5.1 trillion of options that expire gets repositioned into different areas and sectors, puts and calls, defensive, aggressive, different strategies. Still, given this is the largest option expiration ever in the history of the markets coming tomorrow, you could see more volatility tomorrow as well. You can see that here via Friday's OPEX, that is $5.1 trillion, the biggest ever. This is being reported by Zero Hedge, and this chart is from Goldman Sachs Global Investment Research. SPX AM options total $2.9 trillion. Non-SPX, SPX stands for S&P 500, is $185 billion. The SPY ETF, the one that most people trade, the one that I look at every day here on this channel, that option expiration is worth $280 billion. The SPX PM is worth $430 billion. Non-SPY ETF is $455 billion. And single stock options are $870 billion. And I'll just go out on a limb and say quite a chunk of that single stock option number is probably Nvidia. And as Andrew Fisher here, portfolio manager at SIO, he comments and says high gamma will make the market close flat for most. And that's true. There's a lot of hype around these large option expiration dates like the one we get tomorrow, but you don't tend to usually get a lot of action. It's usually the next week. And what's cool about that, I guess, if you're a nerd like me, you can go see how people are already positioning for next week, today. And that will give you a little bit of insight to how this $5 trillion of notional value could reposition in our markets. So if we take a look at trades that are coming through today, this is the unusual options scanner over on Ortex. You have 27 different trades totaling $4.24 million with a positive order value of 46%. But if you take a look at next week's option expiration, it's really bad. It's almost like Wall Street is positioning for a crash. So open interest for next week, just so we're all on the same page. If you buy an option for next week's expiration, which is June 28th, next Friday's expiration, or any other expiration for that matter, if you buy one call, one put, then your open interest is 50% calls, 50% puts. Open interest is contracts that are bought and held in people's brokerage accounts. The open interest for next Friday's expiration is 84.34% puts and 15.66% calls. That means there is over 5 times as many puts for next week's expiration than calls. That's almost like positioning for a crash. Volume today is 42.05% calls and about 58% puts. Now, there are a couple of reasons why investors feel a little bit more worried about the next week ahead for markets. I guess, where do we even start? Oh, we should probably start here. the Swiss National Bank did a surprise rate cut. Those are never fun. Those are never good for markets. The Swiss National Bank cut rates by 0.25% down to 1.25% after already cutting rates in March. It seems like one Fed actually knows what they're doing. Still, rate cuts are historically not seen as a good sign for the economy. Or this will help you sleep better tonight. Fed's Kashkari says it will probably take a year or two to get inflation back to 2%. That's, of course, if we avoid a recession, because if we go into a recession or see economic weakness, then you're likely to see inflation fall faster than that. But I wouldn't say that's necessarily comforting for markets to hear Kashkari say that. Fed Kashkari also said today the economy keeps throwing us curveballs, which are challenging. Founder and CEO of Archimina comments and says, no, you keep living in the past, which is problematic. And I couldn't have said it better myself. The Fed is on the cusp of making a drastic policy error. After all, we don't even know how strong the labor market actually is. It's being reported that job growth was overstated by more than 770,000 jobs last year. Put differently, about 1 in every 4 jobs that was supposedly added last year never existed. That's like completely eliminating all of the jobs gained in 3 whole months of 2023. So basically everyone besides the Fed can see just how weak things are right now. I mean, go talk to people. People are struggling. You know who else is struggling? The Russell 2000. Only 1% of stocks in the Russell 2000 are at a new 52-week high, as small caps continue to struggle to gain traction, which is actually not what you would expect. If someone told you 10-year treasury yields were going to fall 40 basis points, you would expect the Russell 2000 would do well. Instead, the 10-year treasury has dropped 40 plus basis points since it hit that high in October of 2023 at about 4.9%. You've actually dropped almost 50 basis points since that level. And what's happened? The Russell has done absolutely nothing. In fact, the Russell has actually fell since then. That's because markets are becoming concerned over a recession. And who does the worst during a recession? It's your Russell 2000. I should mention while we're here, 10-year treasury yields are up almost 6 basis points today. That's because we did get some troubling economic data. Troubling on the front of the economy and troubling on the front of inflation. You could say almost stagflationary. First up, initial jobless claims came in at 238,000, a little bit higher than Wall Street was anticipating, and this is a further ramp up, kind of like you were seeing in 2022. There is definitely an upwards trend for initial jobless claims. Building permits came in at 1.386 million, expecting 1.47 million. Less building permits, less building, less supply, more housing inflation. At least that's how the markets look at it. I can make an argument the Fed's the reason there is housing inflation to begin with, and I could also make the argument that the way the Fed and the government calculates the housing inflation data is just the wrong way to do it anyways. Mix both of those things together and yeah, housing inflation isn't coming down anytime soon. But hey, what do I know? You had housing starts that came in about 110,000 lower than expected at 1.277 million. Housing starts month over month that came in at negative 5.5%. You were expecting positive 2.2%. Let's just add it on at this point. Keep the bad news coming. And that's exactly what we're going to do next with Philly Fed Manufacturing Index. You were expecting a number of 6. You came in at 1.3. That's really bad. But look at this, Philly Fed business conditions, not just manufacturing, but Philly Fed business conditions came in at 13.8. Last month, you were at 32.4. Business conditions just plummeted. Philly Fed CapEx also went down from 20 last month to 12.1. Philly Fed employment came in at negative 2.5. Last month was negative 7.9. So that's a little bit better. Philly Fed new orders came in at negative 2.2. Last month was negative 7.9, so a little bit better there. But more bad news. Philly Fed prices paid, the inflationary component of this data, came in at 22.50. Last month was 18.70. That's not good. I mean, is it the end-all be-all for the markets? Obviously not, but it is inflationary data nonetheless. Later on tonight, around 7:30 p.m., we will get the inflation rate out of Japan. If that comes in hotter than expected, that could be a problem because Japan is the single largest owner of U.S. Treasuries, over $1 trillion. If Japan's inflation goes higher, Japan needs to raise rates. That could lead some money to leave our bond market and go domestically back to Japan. So just the number to watch for. Don't expect it to do much, but it definitely could have an impact. Tomorrow, we will get much more important data than the data we got today, and that is S&P Global Composite PMI, S&P Global Manufacturing PMI, and S&P Global Services PMI. You're actually expecting all of these numbers will contract a little bit from last month's reading, with markets that are really going to be focusing on that services component of the global PMI. Here today, you have the Dow Jones Industrial Average, which is the outperformer, up 0.27%. The S&P that is pretty much flat. The Nasdaq down 0.1%. The Russell's pretty much flat as well. But look at the VIX. The VIX is doing its own thing, up 6.5% today. Really a testament to what I showed you earlier in all of the bearish defensive options heading on to the S&P 500 options chain. The VIX goes higher when there's more puts being bought than calls. The VIX subsequently goes lower when there's more calls being bought than puts. So the VIX up 6.5% today is a pretty big deal. That's telling you there's a lot more puts being bought than calls. Worth mentioning that if July is a weak period for the markets, that would be a little abnormal because July kicks off the strongest 10-day period of the year for the S&P 500 with average and median returns of 1.54% and 1.91%. The first 2 weeks of July tend to be pretty good for markets. A lot of that has to do with summer tends to be slower. There tends to be less volatility. When there's less volatility, less going on, you tend to get the markets that naturally want to go higher. And I think that's kind of what has been happening lately. There really hasn't been much going on, and you are in this lower volatility, lower volume kind of market environment. When everyone's hyped up around AI, that's the biggest, most prevailing narrative there is right now. Until, of course, we get new data and new information, which will come tomorrow with that PMI data. But in a bigger sense, over the next couple of weeks with the non-farms and new inflation report, the start of earnings season, all of that will be even bigger catalyst. And I mean, eventually Nvidia is going to go through a correction, you would think, and given how much Nvidia is positively affecting our markets as of lately, Nvidia, the S&P, they're kind of like the same thing at this point. One goes, the other one's probably gonna go. Again, today, CNN's Fear and Greed Index is sitting at 44, which is in fear territory. Again, I've never seen this before in my life, where the Fear and Greed Index is in fear and markets are at all-time highs this overextended. I mean, the S&P 500 has an RSI of almost 78, and the triple Qs, which is the Nasdaq 100, has an RSI of about 80, which both of these are severely overbought. For some reason, it doesn't sound like this is going to end well. But if you are bullish, really the only thing that you can count on at this point is a broadening out of the markets. And for that to happen, you need to really see the Fed become a little bit more dovish. You need to really see inflation plummet again. If that happens, we may avoid a crash and maybe you just get small caps and mid caps catching up to big tech. What you don't want to see if you're a bull is a catch down where big tech comes back to reality and starts to match up with the rest of the markets. Here today, you do have 0.79% of all stocks breaking above their 50-day moving average, so today's actually positive from that sense. You have 38.67% of stocks above their 50-day moving average. This is still a really bad number. Almost 60% of stocks are trading under their 50-day moving average. That means a majority of the markets are indeed in a downtrend, but it is positive today. Zero Hedge wrote this post on X with this chart that says, for those asking how much longer the S&P 10 can keep melting up as the S&P 490 stinks, you can see the top 10 largest stocks currently have a P multiple of about 30. And during the dot-com bubble, that hit as high as 47, whereas the S&P 490 has a P multiple of around 18. And it was about the same. It was at 16 during the dot-com bubble. So really, if you're bullish right now, you have to be hoping that the average stock's PEs start to rise. And apparently being overbought is a good thing. The NASDAQ 100's 5-day RSI is over 95. That has happened 16 times since 1990, with a 1 month later average return of 2.9%, a positivity rate of 80%, 3 failed signals, 1990, 2020, and 2021, all macro related. So basically, if this is going to turn into some kind of large crash based on that historical precedence, it's going to be macro related, meaning you're going to start to see the economy take a hit. And in other words, if the economy continues to do fine, then 30 days later, markets will probably be even higher than they are today. Although that's possible, I kind of find it hard to believe, just given how concentrated this market is and how badly Nvidia needs a little bit of a reset here. And that's actually what's happening now. Nvidia just went red today, which is kind of even hard to believe these days. And you're back to green. What a hell of a stock. Let me know what you think about all of this information down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. If you like to stay up to date with markets and get a heads up of what could be coming next, this is the place to be. You guys, most importantly, have a great rest of your day, and I will see you in the next one.